What's up, everybody? Welcome back to the stocktrades.ca YouTube channel. My name is Dan Kent, and in this video, I'm going to be going back to talking on some excellent Canadian stocks, specifically two stocks that I really feel are going to be huge reopening plays for Canadians, for even US investors looking at the Canadian market. These are both blue chip Canadian plays, both of which could be undervalued based on reopening numbers, and we're going to get to it right now. Just before we get started, I just want to give a little update on the channel itself. We used to publish 3 videos a week. Unfortunately, just to the sheer velocity that our premium platform has grown over at StockTrades Premium, we do not have time to publish 3 videos a week. We have experienced some of the fastest growth we've ever seen on the platform over the last 4 or 5 months, and now we are simply going to have to devote most of our time to premium members. We just added our Discord server to the StockTrades Premium platform, and when I look at other subscriptions and platforms I see around, people are charging essentially the exact same amount for exclusive access to their Discord server as we are for our whole platform, which includes model portfolios, dividend stock picks, growth stock picks, a Q&A, again, our Discord server. We have stock screeners. We have an IPO screener. I promise you there is not a better value in the country. There might not be a better valued service in North America right now. But again, 30% discount in the description below. But let's get to our first stock that I think could have the potential to outperform on reopening, and that is Canada's, in my opinion, Canada's best oil and gas producer, Canadian Natural Resources Limited. So a lot of you, if you're readers over at stocktrades.ca, you interact with me on Twitter, which, by the way, you can give me a follow. I'll put a link in the description. Or you just have interacted with me in some way in the past. You'll know that I am fairly bearish on the oil and gas sector. So why am I highlighting a stock like Canadian Natural Resources? And one of the main reasons is because this would be a short-term reopening play. I still do not have a lot of confidence in the long term when it comes to major oil producers. I've owned them for a significant amount of time and they have done nothing but burn me. But I do realize right now that oil is set to see significant demand boosts in 2021 and likely 2022. And I also do realize that commodities tend to perform better in an inflationary environment. And we just had the United States upgrade their inflation outlook from 1.8% to 2.4%. So there is a very good chance that oil prices are going to be maintained for the foreseeable future. Now, they did say that in 2019, peak oil demand was reached. So as a long-term play, just because of the cyclical nature of these stocks, it's not something that I own, but realize that a lot of people tend to play these cyclical options in terms of the ebbs and flows of the economy. And right now, there is no questioning that oil is a promising play. Now, what do I mean by I've been burnt owning these producers? Well, if we look at a 10-year chart in terms of returns, we can see that Canada's 4 major players, Cenovus, Suncor, Imperial, and Canadian Natural Resources, have performed, to put it lightly, abysmally. I mean, these are including dividends. This is total returns. Canadian Natural Resources has actually been the only Canadian oil producer on this list of 4 that has kept their head above water. They've returned 13.92% as I'm filming this over the course of the last 10 years. We see Imperial Oil has lost 27%, Suncor has lost 10%, Cenovus a whopping 63% essentially that investors have lost over the last decade owning these major oil producers. And why is it that these major oil producers are providing these types of returns? Well, in my opinion, it's because the commodity is just too easily manipulated. We saw it back in mid-2014 when the market was flooded, and we saw kind of a double whammy in 2020 when not only the oil market was flooded before production was cut, but there was also COVID-19. But getting back to the positives and the real reason why I think Canadian Natural is a strong short to mid-term option in the oil market is just because I believe it is the best in class Canadian producer by a long shot. So if we actually dig into what Canadian Natural Resources does, they are one of the largest oil and natural gas producers in Western Canada. They have operations that are supplemented in the North Sea and in offshore Africa. The company's portfolio includes light and medium oil, heavy oil, bitumen, most importantly synthetic oil, natural gas liquids, and natural gas. So for the purposes of 2020, I'm actually not going to speak very much on Canadian Natural when we look at 2020. It might not be a one-off event, but it is certainly a year that we will likely never see again in terms of the absolute collapse of the oil industry. So when I look at numbers today, I'm going to look at 2019 numbers to highlight to you how strong of a company Canadian Natural Resources really is. The only way I'll speak on 2020 numbers is when I get to the dividend here in a bit. So they averaged 1.1 million barrels of oil equivalent per day of production in 2019, and the company estimates that it holds over 11.5 billion barrels of proven and probable crude oil and natural gas reserves. So the company generated over 5.4 billion in net income in 2019 and an operating cash flows of just shy of $8.3 billion. So this is currently Canada's largest oil and gas play. Suncor was bigger than Canadian Natural for quite some time, but due to the fact that Suncor cut its dividend so early into the pandemic and some operational efficiencies, Canadian Natural has overtaken it. Now the gap is somewhat closed. At the time I'm filming this, Canadian Natural is worth around 46 billion, where Suncor is 45.5. So Suncor definitely has rebounded, but I view Canadian Natural as the much better company. And the first thing I'm going to go over is the company's dividend. So if we look to this dividend chart, we can see that Canadian Natural has consistently raised the dividend for a very long time. They actually have a 20-year dividend growth streak, and that includes a recent dividend raise not too long ago, actually in early March. So you can see that in the early 2000s up until about 2010, dividend growth really wasn't that extensive, but it's when high oil prices started to happen in 2010 up to around 2014 where Canadian Natural really started to shine in terms of dividend growth. I mean, it's pretty evident by this chart and the overall velocity over the last 11 years that it is raising its dividend at a faster pace. And interestingly enough, its most recent raise actually comes in the double-digit level. This is a company that, despite posting horrendous earnings and revenue in 2020, managed to raise the dividend by over 10% in 2021. And this extends them to, as I said, 20 years and actually puts them into one of the top 15 companies in Canada for dividend growth. And in terms of dividend, I know what you're going to be saying right now. If you haven't looked too much into Canadian Natural Resources, you're going to say, Dan, their payout ratio is currently 450% of 2020 earnings and approximately 110% of free cash flow. But again, as I reiterated, it is just not feasible and probably not the best analysis to look at 2020 in terms of the shape of these oil and gas producers. So if we look at Canadian Natural estimates, analyst estimates moving forward in terms of earnings per share, they expect earnings per share of $3.45 in 2021. If we compare this to a loss of 37 cents in 2020, this is a drastic rebound for Canadian Natural. And more importantly, they pay a $1.88 dividend on an annual basis. So as you can see, their dividend goes from 450% of earnings to just over 50%, which means that not only is this dividend very, very unlikely to be cut, it is also a very real possibility that Canadian Natural Resources will continue to drive double-digit dividend growth moving forward. So let's head back to the start of the description on Canadian Natural and discuss its cyclical nature again. And if you don't know what a cyclical play is, especially one that is placing a huge reliance on the underlying commodity, this is the chart you'll want to look at. And if we look to Canadian Natural's chart, we can see that this is a company that has essentially followed the price of WTI crude oil almost to a T. We can see that the ebbs and flows in the price of oil are pretty much always reflected in the price of Canadian Natural. And this would be the exact same as a gold play, a silver play. Stocks that rely so heavily on the underlying commodity that they produce revenue from will follow that commodity fairly closely. In fact, usually when we see commodity plays like this, they are more volatile than the commodity they track. So we can see that when crude oil really shoots up here in 2008, Canadian Natural shoots up even further, but when it collapses, Canadian Natural collapses even further. We can see this in 3 instances: in 2008, back when the markets were flooded in 2014, and most importantly, when the markets were flooded in 2020 and COVID-19 hit. So this is what I mean by this company could be a very strong short to midterm oil play. In order to really make strong gains in these companies, you're going to have to time these economic cycles. You're going to have to buy at the low and sell at the high. If not, you're likely to end up with a situation like I showed you in that 10-year chart, where there's pretty much only one major oil producer here in Canada, dividends included, that has made anybody any money. But moving forward in 2021 and likely in 2022, we are going to see big demand for oil. The next stock I'm going to talk about is still struggling in terms of fuel sales, which essentially means that the demand just isn't there yet. We're not seeing air travel. We're not seeing a lot of oil demand. And I predict that moving forward in 2021 and 2022, the velocity of the demand is going to increase and Canadian Natural is going to benefit. So all in all, excellent dividend, but a cyclical play that you can definitely look at for short-term upside potential in the event of rising oil prices. But the next stock we're going to look at is definitely one that I see potential in. In fact, it's one of our foundational stocks over at Stock Trades Premium, and that is, and I'm sorry if I pronounce it wrong, Alimentation Couche-Tard. So full disclosure, I own this stock. I bought it back in December. It dipped significantly because of an acquisition that I'll talk about later, but we ended up relaying it to premium members as a pretty much slam dunk play in the $36 range, and I ended up loading up as well. The stock trades in and around $41 right now, but I really feel that it is one of the best blue chip plays in the country right now. What does Couche-Tard do? They are a convenience store operator. They're actually one of the largest convenience store operators in the world. They have a very, very simple business model. They sell gasoline. They sell essentially gas station food, gas station merchandise. They are a typical convenience store here in Canada and around the globe. We don't see them too often anymore here in Alberta. They're actually transitioning most of them to their most popular brand, which is Circle K, but they have Max stores in Quebec, they have Couche-Tard stores, and they have a number of brands globally, but their strongest definitely is Circle K. So if we whip over to the income statement here, we can see that this is a company that generates a significant amount of revenue. We can see that the company generated $72.28 billion in fiscal 2020. And if we head down to the EBITDA, we can see that this is a company that generated $6.1 billion in EBITDA last year. And in terms of diluted earnings per share, this is a company that went from earning 33 cents in 2011 to $2.79 in 2020. And this is one of the main reasons why this company has one of the fastest growing dividends in Canada, actually in North America. It has an 11-year dividend growth streak, and it's grown its dividend by just under 25% on an annual basis. So it's a Canadian dividend aristocrat. It is essentially set to double its dividend every 4 years, and the company only yields 0.85%. Why does it yield this low? Well, that is because it has provided insane capital appreciation to investors as well. And if we look to a 10-year chart of the company, if you had invested $10,000 in this company 10 years ago with dividends included, you would have $106,690. That is crazy level returns, and this is one of the main reasons why Couche-Tard is growing the dividend so fast, yet its yield is still so small. As a company's share price increases, its yield goes down. So if Couche-Tard is growing its dividend at such a fast clip, yet its yield is staying relatively the same or even decreasing, that means its share price is going up even faster. So to the brass tacks, why is this a strong rebound play? Well, for one, they had fuel sales that were significantly impacted in 2020. If we look to this quarterly revenue chart, we can see that revenue took a massive hit. And in fact, on a year-over-year basis, fuel sales fell 41% in the US, 41% in Europe, and 33% in Canada. This is a company that generates a ton of money from gasoline sales. So this is why on a year-over-year basis, in terms of total revenue, because they do sell merchandise and other things, this is a company that saw a 27% dip in total revenue. But this is about as short-term as it gets in terms of a dip. This is a company that saw revenue dip 27%, but they also grew earnings by double digits. So it's safe to say when things get back to normal and people start driving again, they start going to these service stations, Couche-Tard is going to be able to not only grow its top line by double digits, but also continue with bottom line double digit growth. And third and final reason, this is a very underrated EV play. Couche-Tard has been quietly testing EV operations in Norway, charging operations with extremely positive results, and because of this, the company essentially plans to start rolling out charging stations in North America in 2021. And they've actually been directly quoted stating that it would like to find a way to deliver even home charging stations. So final thing I want to speak about is valuation and why it has essentially got to this valuation. And if we look at Couche-Tard in terms of price to earnings, price to sales, price to free cash flow, price to book value, this is a company that has essentially never been cheaper than it is now. If we look to price to sales, it is a little higher than its 3 and 5 year median averages, but that is because its revenue has dipped so much. But if we look to price to earnings, with a price to earnings ratio of 12.47, this is lower than the 3 year median, the 5 year median, the 10 year median. It's actually, in terms of a 10 year average price to sales, this is a company that is trading at nearly a 30% discount. If we look to the price to earnings to growth ratio, it is a 0.3, which is essentially stating that the market is not factoring in Couche-Tard's growth potential with its current share price. If we look to price to free cash flow as well, it is lower than its 3 year, 5 year, and 10 year median. In fact, it is almost half of its 5 year median average. So why did the company dip so much? Well, it was because of an acquisition of a French grocery company, Carrefour, that ended up not going through. The French government ended up shutting this down, and because of the debt loads that Couche-Tard was going to take on just with this acquisition, the market did not react well. In fact, the stock plummeted on rumors of the acquisition and then fell even further to the $36 range when the acquisition actually came out. A lot of people were wondering why Couche-Tard would want to go from a high margin business and what they do now to a grocery store business in Carrefour, especially internationally. But now that that's done, it's not going to happen. The stock price really should have recovered. I think there's a lot of investors right now who are maybe a little skeptical on the company's management. But the fact is, this has been one of the best managed companies in Canada over the last 20 years. So I have, as a current shareholder, just irresistible dip that I bought the company on. I'm not too worried about the company's management. I really feel they're going to return to stellar growth in 2021 and 2022 when it comes to both the dividend and share price. Now, it's not likely we see the insane level growth that they posted over the last 10 years moving forward. This just isn't really feasible. But Couche-Tard at 12 times forward earnings is just a price that is so cheap to me right now. In fact, I'm likely looking to add more as I move forward. So everyone, that's pretty much it for the video. Hope you liked it, and I really hope you still watch us every single Sunday. We're going to be packing in a ton more content in these individual videos. And most importantly, if you are interested in joining Stock Trades Premium, I have left a discount code, 30% off, in the description below. We just launched our Discord channel. There is, I guarantee you, not a platform that provides more than we do for the price we are offering. That is why we are growing so fast. So if you do want to be a part of it, again, link in the description, and we'll see you next time for more great Canadian content.